Mandelbaum Barrett's 10th annual Tax, Trust, and Estates Forum. It is so wonderful to see so many of our clients and professionals here today as we explore some of the most pressing topics in financial and estate planning. Before we dive in, I wanted to introduce myself. My name is Lauren Lynch, and I have the privilege of serving as the firm's Chief Marketing and Culture Officer here. This role gives me a really unique perspective into what makes this firm so special and so unique. For over 90 years, we've been a trusted legal partner offering sophisticated, hands-on attention to our clients' needs. From navigating high-stakes business deals to planning for your family's future, our full-service, relationship-based approach ensures that our clients receive comprehensive support every step of the way. Our ethos is built on relationships and focused on results, and for us, it's not just a slogan. It's the foundation of everything that we do. Nowhere is this more evident than in our Tax, Trust, and Estates practice group, whose expertise and commitment have empowered clients for over a decade through things like today's forum. And with that in mind, I do have a special surprise for our team today. If I could have our CEO, Bill Barrett, come up, we wanted to just commemorate the fact that this is our 10th year doing this.
Thank you. Be very brief. I want to first just thank everyone, as Lauren did, for being here today. This is a great event. It's always very popular, and our team really does an amazing job always every year digging into, what's the latest and greatest thing that our clients need to know. And this room is always filled with some of the finest practitioners in the world of accounting, financial advisory, other lawyers, and clients who come to gain the wisdom and knowledge that this group has every year. And as I learned today for the first time, I didn't know the Park Avenue Club had another parking lot, because I had to park over there because every spot was full, which is a testament to them. But what I really want to do is present this to Steve. For those of you who've never worked with Steve Holt, I've been practicing law for 26 years. I think that he's the finest tax practitioner that I've ever crossed paths with in my career. One of the most diverse practitioners, and this was kind of his brainchild years ago. So I just wanted to take a moment and present this to Steve for 10 years. And Steve, congratulations, and thanks for all the work. Appreciate it. So enjoy the rest of the morning, and again, thank you all for being here today. Lauren, I'll give it back to you.
Thank you, Bill. So to kick things off today, we're going to start with a short clip that captures some of the exasperation that we all feel when we're trying to navigate taxes. It's a relatable reminder of why the guidance of skilled professionals is so essential.
Oh my gosh. Where's all your money gone, Daddy? Taxes. 9, 10, 11. Let me fix my houses. It's okay. It's part of the game. No, it's not. It's not fun. It's not fun to what? It's the worst part of the game. Oh, it's what? Taxes.
Now, while the child in our video might think that taxes are nothing but frustration, Stephen Holt sees it differently. As chair of our Tax, Trust, and Estates practice group, Stephen is dedicated to helping clients understand and manage the complexity of taxes with expertise and insight. Stephen brings a depth of experience advising on a wide range of clients, from corporate executives to branded companies to family-owned businesses and not-for-profits. His unique insights have guided the growth and protection of assets for clients, including legacy brands in luxury goods, travel, and healthcare. Beyond his professional accomplishments, he's also deeply engaged in community organizations, serving on the board of trustees of our very own charitable foundation, as well as other networks that are dedicated to advancing knowledge in tax and estate planning. It's an honor to have him with us today leading this event. Please join me in welcome Stephen Holt.
Thank you, Lauren. Appreciate that. Welcome, everybody. It's great to see all these familiar faces and new faces. Terrific turnout, and we thank you for spending your morning with us. We're going to cover a lot of topics, kind of rapid fire. We have 10 items that we want to share with you. The whole team is going to present. So please leave your questions to the end. If you could, we'll have plenty of time for Q&A after the presentation. You'll also notice that there are cards that you can scan to get the materials for today's event. We have several handouts. Be sure to download those. And we're going to have a raffle as we do every year. You must click on the QR code and register that way to get in the raffle. That's the way to get in, so be sure to do that. Lauren will explain how to do that a little later and give you plenty of opportunities to do it. So that's how you join the raffle. So I want to start by introducing our team. First, we have Marty Hoffman. Marty joined the firm in 2013, I believe, as a shareholder. Good friend, great practitioner. He practices in the firm's trust and estates and taxation practice groups. His primary focus is on ERISA matters, that's qualified plan matters, including pension planning and qualified plan administration. Marty was one of the premier and first practitioners in the ERISA area, dating back a very long time, so he's quite an expert in that space. Marty also handles estate planning and administration, tax and probate litigation, business succession planning, entity formations and planning, mergers and acquisitions, and important for us, IRS and state tax representation in tax controversy matters throughout the United States. Marty is quite expert at it and has gotten incredible results for our clients. Marty has several published works in the qualified plan area and has been designated a super lawyer and is listed as a best lawyer in America on the Best Lawyers in America list. Next is our partner, Jason Marks. Jason is also a member of our Taxation, Trust, and Estates Planning Group. He serves his clients in the area of tax and estate planning, estate administration, elder law, life care planning, asset and wealth protection planning, special needs planning, tax and business planning, and also tax controversy work. Jason is a member of the National Academy of Elder Law Attorneys and a member of the Board of Trustees and Treasurer of the New Jersey chapter of the National Academy of Elder Law Attorneys. Our newest member of the group is Sean McClellan. Sean is a partner also in our taxation and trust and estates practice groups. He specializes in matters relating to business services, estate planning, elder law and Medicaid planning, and special needs planning. Last but certainly not least is Donnie Dennison. Donnie is an associate in the firm's elder law department, where he focuses on guardianships, Medicaid planning, special needs, and estate administration. Donnie is passionate about protecting the rights of the elderly and disabled and frequently lectures on the topic. I think you'd be thrilled to hear Donnie speak on any of those topics. We're going to start with Donnie, who's going to talk about Medicaid annuities. Thanks everybody for coming. Terrific.
Good morning, everybody. Thank you for coming out on this cold morning. Hopefully, we're able to get through most of these presentations in the 10 minutes allotted. Certainly, this topic, Medicaid compliant annuities, is a subject that 10 minutes could not possibly provide you with enough insight or knowledge necessary to truly understand how these work. In fact, it would take hours to really wrap your head around how these work, but hopefully it gives you just enough information to start a conversation with your clients, because Medicaid compliant annuities can be a really useful form of asset protection or asset preservation planning in most contexts. And so I would like to talk a little bit about first what Medicaid is generally, and then go into sort of how can Medicaid compliant annuities benefit your client. Medicaid is a form of means-tested benefits that provides coverage for people who require long-term care, whether that be in a nursing home, assisted living, or at home, under home care benefits. Because Medicaid is a form of means-tested benefits, there are strict asset and income requirements necessary to first apply, become eligible for Medicaid, as well as to stay enrolled in Medicaid once you are receiving benefits. The distinction that Medicaid draws between assets and income is really what's at play when it comes to these Medicaid compliant annuities. It's the loophole. It's what we exploit, for lack of a better term, in order to preserve assets either for a spouse, who we would call the community spouse, the well spouse, or the next generation, children, for example, in cases where maybe there is no spouse, but there are children. So Medicaid for a single person has a strict asset cap of $2,000. The same is true for other government programs like SSI. For a married couple, the rule is slightly different. For a married couple, the Medicaid regulations allow the community spouse, the well spouse, to retain a maximum, and this changes every year slightly, a maximum of $154,000. The purpose of what we call community spouse resource allowance, that $154,000, is to make sure that the well spouse is not completely impoverished, that they're able to continue living in the community, and that they won't themselves require means-tested benefits. Like I mentioned, Medicaid distinguishes between assets and income, though. For a person who is single and who has income in excess of about $2,700 a month, even though that individual can still technically qualify for Medicaid, they may need to use something called a qualified income trust. I'm not going to get into that. They're also known as Miller trusts. I'm not going to get into what a Miller trust is and how it functions, frankly. They're kind of silly. But you can still technically qualify for Medicaid as a single person if you have income in excess of $2,700. The same is true for a individual who is married, who they themselves are applying for Medicaid, say the husband in a marriage. But the wife's, in this case, the wife's income is not counted for purposes of the Medicaid planning. And so the wife, the community spouse in my hypothetical, could have unlimited income. And so that's where these Medicaid compliant annuities allow us to preserve assets. Because in the case of a married couple, to the extent that we are able to spend down, aka annuitize, the assets in excess of the community spouse resource allowance, that $154,000, we're turning money in excess of that community spouse resource allowance into a stream of income payable to the community spouse. So that as of the first day of the month that we're seeking eligibility through the Medicaid program, on paper, the community spouse, as well as the Medicaid applicant spouse, on paper, their assets do not exceed $154,000, and in time, as the community spouse starts to accumulate that wealth back, as that money starts coming in the form of an annuity, Medicaid will no longer look at the community spouse's assets. They'll only look at the Medicaid applicant's assets going forward. Now, that's Medicaid planning generally for a married couple. It's different for a single person. Obviously, there's no community spouse resource allowance for a single person. But what there is the ability to preserve assets for, say, children, or really anyone who you would want to, for instance, benefit under your will. It doesn't have to be children, necessarily. But the way these annuities are structured is slightly different for a single person. And what we're using for a single person's Medicaid compliant annuity, the rules that we're exploiting, so to say, are more so the gifting prohibition, the rules against gifting in the world of Medicaid. So Medicaid as a form of means-tested benefits does not allow you to just freely give your money away. Medicaid defines a gift as a transfer of an asset for less than fair market value. Medicaid has this 5-year look-back concept And the 5-year look-back concept essentially stands for this idea that Medicaid, when an application is made, is going to look back, conduct an audit of sorts into your financial history 5 years from the date of the application to determine whether you transferred an asset, whether that's a car, real property, cash, to any person other than a spouse. This is for a single person. If you've transferred an asset to any person for less than fair market value, they impose a penalty on them. That penalty is based on a figure that changes slightly every year called the penalty divisor. This year, the penalty divisor is for every $13,000 gifted in the 5-year look back, Medicaid will not pay for 1 month of care, whether that care is, again, at home, in a nursing home, or an assisted living facility. And so for a single person, these Medicaid compliant annuities, we're exploiting that rule. To the extent the single Medicaid applicant has assets in excess of $2,000, which is the asset cap for a single person, to the extent that person has assets in excess of $2,000, we would then gift a portion of those assets to their children, to really any beneficiary that they would have in their will, whoever they desired, knowing that the gift is going to result in a transfer penalty. Well, that doesn't sound good, right? But with the remaining portion of the assets that are left, that are preserved, that are not gifted, we then purchase a Medicaid compliant annuity, or fund a Medicaid compliant annuity, for the purpose of getting through the penalty period that results from the gift. And so, just using round numbers, for example, in many cases, I think it's very realistic to consider a gift of about 40% of a single person's assets in excess of $2,000, which means that 60% of the assets in excess of $2,000 are then going to be put into a Medicaid compliant annuity. Now, the Medicaid compliant annuity in this situation is going to be calculated before it's purchased to run concurrently with the anticipated gift penalty period. So what is the benefit of doing this? It's simply, you're able to make an advance on an inheritance, and that advance, even though it's only about $40,000, is a lot better than divesting yourself completely of assets to qualify for Medicaid. So there are options for people to not completely become impoverished and qualify for Medicaid benefits, and there are options that should be considered, in advance of ever requiring skilled nursing care, whether that's at home again or in a nursing home. That's about it, a general overview of Medicaid planning. I know I covered it very quickly. Again, only 10 minutes, but to the extent there are questions, I'm happy to address them during the Q&A. Thank you.
Thank you, Donnie. Jason and I are going to talk about some of the things that you might do if you funded a SLAT, and he'll tell you what that's about, and how you can be flexible in dealing with them if you feel that you overfunded. So I'll let Jason start the discussion.
I guess I can. There we go. Good morning. Thank you for everybody for coming out today. As Steve said, we're going to kind of piggyback on what happens if you've gone through your estate planning and have made contributions into an irrevocable trust. In this case, we're going to be talking about funding a SLAT, or a spousal lifetime access trust. And realize that maybe you've given away too much, or you're not comfortable with the amount that you've put in, and it just doesn't sit right with you anymore. What are some of the options? I'm going to talk a little bit more about the alternatives to the SLAT, and Steve will address some of his options as well. As many of you know, since the beginning of this year, wealthy taxpayers have been able to transfer a maximum amount of $13,610,000 of assets to individuals other than a spouse to gain and utilize their lifetime exemption from the federal estate and gift taxes. That's the maximum amount for 2024 that can be gifted estate tax and gift tax free. That number is going to be increasing in 2025 to $13,999,000. But under the current tax regime, under the 2017 Tax Cuts and Jobs Act, that number, that lifetime exemption, is scheduled to sunset. Okay, and it will sunset down to $5 million adjusted for inflation. So we can probably expect somewhere about a $7 million per person lifetime exemption if Congress does nothing to make the current law permanent. But what if Congress does take action? Okay? Later on in this program, I'm going to be talking more about the Tax Cuts and Jobs Act, but for now, suffice it to say that the odds that the lifetime exemption will remain at the level where it is now is pretty good. So for those individuals who are planning on a Democratic victory last month, they may now be looking in the rearview mirror wishing that they had not made the transfers that they had made earlier in 2024 or prior years, expecting that the sunset was going to actually take place. Over the next 13 months, we're going to have to do a lot of review and analysis for our clients to determine their circumstances and whether utilizing the exemption during their lifetime is an appropriate strategy. So as a quick refresher, individuals looking to make gifts must first use available to them any deceased spouse unused exemption. So if under the federal law, there's a function called portability, where if one spouse dies and they have unused exemption, the surviving spouse can transfer over or port over to them the unused exemption of the deceased spouse. When making gifts, the surviving spouse must use that deceased spouse unused exemption, or the dessous, first. After utilizing whatever dessous they may have transferred over, they then must use their basic exemption. That's the exemption that they had through 2017 before the Tax Cuts and Jobs Act was implemented. And once they've utilized their basic exemption, then what's left and available to them is that bonus exemption, the exemption that has been increasing ever since 2018 to get us to the $13.61 million where we are today. There are several factors, obviously, when we talk to our clients and advise them about what we should be considering in making gifts, but certainly their wealth, their overall wealth is a primary consideration. Clients should not be transferring more than they can afford to transfer. So for individuals with wealth of under $7 million, $14 million for a married couple, there's probably no compelling tax reason to make any transfers right now. There may be other compelling reasons to make transfers, many of which Donnie alluded to in terms of Medicaid and lifetime long-term care planning. But from a pure tax perspective, individuals and couples with under $7 million or $14 million respectively may not be looking to transfer such large amounts currently and moving them away. What I'd like to do is run you through a couple of illustrations and use these as examples. So let's talk about an 88-year-old widow who's got about $6 million of the dessous, the deceased spouse unused exemption, about $20 million of assets, $5 million of which consist of her primary residence. She's made no prior taxable gifts during her lifetime. Her investments consist of mostly low basis assets, and she's comfortable giving away about $10 million. Assuming Congress does nothing, does not act, it would be impossible for that individual to even touch that bonus exemption, that additional exemption amount that she has before 2026, before the 2017 TICSA does sunset. Her $10 million gift would use $6 million of the dessous, $4 million of the basic exemption, so she would still have about $4 million of basic exemption remaining before she's able to give away any or touch her bonus exemption. even if she were comfortable giving away more. That would only, let's say $15 million. She would only use $2 million of expiring bonus exemption. And assuming she kept the $5 million home, she would have no other assets to live on. So it's important when talking to your clients, understand what the assets are, the basis, the income and capital gains considerations that may affect the client, and whether or not it's better to give it away and take advantage of the exemption, or, I hate to say it this way, die with it and get the benefit of the step-up basis. Let's talk about another situation. Let's refer to a married couple with children and grandchildren. They've got about $25 million in assets. If the bonus exemption expires, they would not be out of the woods because they won't have sufficient exemption to shelter their estate from the estate tax. This couple also is not wealthy enough to comfortably use their entire exemption, either the basic or the bonus exemption, prior to 2026. To use their bonus exemption while ensuring that they have sufficient assets to live on, as advisors, we might advise them to fund a trust called the Spousal Lifetime Access Trust, or as we use the acronyms in the alphabet soup of estate planning, a SLAT. Okay? Essentially, a SLAT is a trust. It's an irrevocable trust in which spouse 1 creates an irrevocable trust for the benefit of spouse 2, and usually also for their descendants. That's the simplest way of describing what a SLAT is. So oftentimes spouses will create one trust for the benefit of for the other spouse. The problem with the SLAT is if spouse 2, the beneficiary spouse, predeceases the settler spouse, the spouse who created the trust, the assets in the trust devolve to the benefit of the descendants, the children, grandchildren, etc., either outright, sometimes they could remain in trust for the benefit of those descendants. And what happens is that spouse 1 is left without any access to the assets that are placed into the trust. So what do we do? Well, spouse 2 can create a SLAT for the benefit of spouse 1. We do need to be careful so as to not trigger what's called the reciprocal trust doctrine. It's an IRS doctrine that basically says if two spouses create identical trusts for one another and fund it with virtually identical assets, the IRS is going to say you haven't created a trust for the other spouse. You've created a trust for yourself, and they will bust the trust essentially. So there's no tax benefit to the SLAT. So to avoid the reciprocal trust doctrine issue, we create trusts at different times with different assets, and the economic benefits for each of the beneficiary spouses should be substantially different so as not to trigger that reciprocal trust doctrine. But still, if upon the death of one of the spouses, even with what I'll refer to as, the reciprocal SLATs, if upon the death of one spouse, the surviving spouse still is left without any assets, at least half of the assets that are in that trust. So what do we do? One option is to look to other jurisdictions. Domestic asset protection trust jurisdictions can allow for an individual to create a trust for the benefit of themselves. It's called a self-settled trust. So I create a trust, name myself as a discretionary beneficiary. Substantively, the terms of the trust are similar to the SLAT. But case law and IRS releases have held that if a governing jurisdiction's law allows creditors of a settler to attach to a self-settled trust, then the settler has retained a right of possession that would cause the assets to be included in their estate. Similarly, case law and IRS releases have also held that when a governing jurisdiction's law does not allow a settler's creditors to attach to such fully discretionary trust assets, the trust is not included in the settler's estate for federal estate tax purposes. So what's important here is picking the right jurisdiction. Jurisdictions like Alaska, Nevada, South Dakota, these are jurisdictions that allow for the creation of self-settled trusts where the creditors of the settler cannot attach to the assets in the trust. As a result, the assets can be out of the estate for estate tax purposes, protected from creditors, and at the same time, the settler can be a discretionary beneficiary of the trust. I seem to be out of time on this, so thank you for listening.
Thanks, Jason. So a lot of you as advisors and some of our clients here actually set up SLATs over the last couple of years or are considering doing so. Again, the opportunity to capture the bonus exemption amount is still available. It may, in fact, be made permanent, as Jason noted, so there may not be as much interest in transferring large amounts of assets. But I want to point out that for our clients who are well off and do, in fact, one day face an estate tax liability, transferring assets during lifetime, even though you may not need to do so to capture the bonus exemption amount, remove all the appreciation. So, take a 50-year-old that sets up 2 SLATs, puts $27 million in the SLATs. During his lifetime and the lifetime of his wife, that could double or triple in value. All that appreciation is removed from the gross estate. Very powerful planning for saving estate taxes. A lot of our clients, fearing that the exemption amount would in fact be clawed back, did in fact make substantial gifts using up to $27 million of exemptions, but they were worried. What happens if there are financial circumstances that change? What happens if there's a family emergency, a financial calamity? How are we going to make sure that we have unlimited access to those assets for the rest of our lives? The good news is there's drafting strategies that can be used to make sure that there's a lot of flexibility if any of those things happen. And I just wanted to go over some of them. For those of you who did SLATs and we did them, these are all in your trust agreements. The first, I call them SLAT backdoors. The first SLAT backdoor is to include what's called a special power of appointment. A power of appointment gives a third party the right to direct the disposition of the assets under certain circumstances to certain individuals. With a special power of appointment, in order to make it work and not cause the assets to be includable in the grantor's estate, the power has to be held by an independent, unrelated person or persons. We normally might designate 2 or 3 holders of the power. By unrelated, we mean that they don't have an interest in the trust. So they're completely independent. If something were to occur that the grantor needed to get the assets back, let's say because the grantor's spouse died and there was a financial need, the holder of the special power of appointment could effectively give the assets back to the grantor. Not a great strategy for planning purposes, but certainly for cash flow management purposes, it's very important to have that. Secondly, most of these trusts are structured as grantor trusts. A grantor trust is a trust where the income of the trust is includable in the gross income of the grantor. Normally, in many instances, the grantors will be in lower tax brackets, so it's beneficial for the grantor to pay the tax rather than the trust. The trust pretty much has a 37% flat tax rate. So if you're able to have the grantor pay the tax at a lower rate, you're going to save income taxes. In addition, the transfer of the tax on behalf of the trust by the grantor is a gift to the trust. So it allows for additional gifting to the trust without use of any exemption, including the annual exclusions. It will happen, though, in many instances where paying the taxes by the grantor becomes a burden for the grantor. So we include a tax reimbursement clause. Under this provision, the trustee has the power to make a distribution to the grantor to cover his or her tax liability attributable to the income of the trust. This is permissible under the federal trust, estate and gift laws as long as the state law permits it, and New York and New Jersey both do. So you can actually have the ability to get the money out for tax reimbursements if you need it. The power must be exercised by an independent trustee. It can't be a related or subordinate trustee. And it should be exercised sparingly and not regularly, meaning do it once in a while, do it in an emergency situation, but don't do it every year. The power is most important where the spouse is no longer a beneficiary. While the spouse is a beneficiary, distributions can be made to the spouse to cover the tax liability, so it becomes important after that. One of the things that a lot of our clients question is what happens if my spouse does in fact die and now the assets devolve to my children, and assuming they're continued in trust, where is my access point? We give the spouse a testamentary power of appointment where pursuant to the terms of her will or his will, the spouse can direct that the assets go back into a continuing trust for the benefit of the grantor. The grantor cannot be the trustee of that trust. It would have to be a discretionary trust with no guaranteed distribution rights, but it effectively gets the assets back to the use of the spouse. Next, we build the trust so that it can be decanted. A decanting is a pouring of the assets out of the trust into a new trust. That gives you the flexibility to change the terms of the trust if circumstances change in your family. The beneficiaries of the recipient trust have to be essentially the same. There can be some changes in their beneficial rights, and you can't completely change the trust, but it gives you some flexibility. Lastly, the marriage could dissolve. We've had a couple cases like that. Nobody planned for it. Now what happens? Now you have your divorced spouse as a beneficiary of a trust, which most grantors wouldn't want to do. We provide in the trust that if the marriage dissolves, the spouse is deemed to have predeceased the grantor. His or her rights then end. He or she no longer can serve as trustee, and basically the trust continues for the exclusive benefit of the children. So these were dramatic opportunities for clients. It's a big decision to transfer that amount of wealth. It's obviously one that you can see the value of, but we wanted to make sure that our clients felt protected and didn't feel at all uncomfortable about doing this type of planning. So the good news is, any of you who did these or plan to do them, these provisions are going to be in the trust, and you're going to have the opportunity to continue to enjoy your assets indirectly for the rest of your life. Thank you for that. I'm going to now introduce Marty, who's going to talk about the Corporate Transparency Act. It's still here. It's not going away. We all have to deal with it, and time is running very short. So Marty's going to give you all the tips on how to deal with that. Thank you.
Good morning. Corporate Transparency Act has been around for a while, and a number of people thought that the courts would stop the enforcement of that. Good news or bad news is, at the end of October last month, the court upheld the validity of the Corporate Transparency Act, and it's going to go forward. So what is it really? Well, the Corporate Transparency Act was enacted in 2021. It was effectively created to create a national database of ownership and registry of owners and small businesses to prevent the use of small businesses as a way of money laundering, terrorism, and hiding assets for businesses. The CTA, which is the Corporate Transparency Act, has created what's called the FinCEN, the Financial Crimes Enforcement Network, which is now in charge of regulating this. And basically, eligible businesses have to report and register with FinCEN. They have to report what's called a beneficial owner. They have to report who are the applicants. The reporting estimates are that approximately 32 million businesses will have to register by the end of this year to comply. The original filing deadline was 30 days after formation. a company set up prior to January 1, 2024, they were given till the end of December 2024 to register. Any businesses set up during calendar year 2024 have a 90-day window to register. Any businesses created after January 1, 2025 have to register within 30 days of their date of formation. Formation is deemed the filing with the Secretary of State or any other similar registry office in the state, or when a foreign entity registers to do business in the United States. And basically, a reporting company is any company that's not specifically exempt, which includes about 23 classes of businesses that are typically in the financial, banking, and finance industry. There is also an exception for small businesses that have more than 20 employees and have gross receipts in excess of $5 million per year. That presents an interesting problem. So if I set up a new company today, the law says I have to look at my tax return last year to see if I had $5 million of sales. Well, if I set up the company today, I didn't file a tax return this year, so no matter how large my company is today, I have to report. I may be exempt in the future, but as of today, I have to report. And this does not exclude any companies that have been dissolved in the past 2 years. So if you had a business that's been dissolved, you still have a filing requirement for these types of businesses. So what do we have to report? We have to report a beneficial owner. And a beneficial owner is deemed as anyone who owns more than 25% of the business or who exercises control. That can be an officer, director, a person with authority to remove or appoint officers and directors, anybody who has any kind of substantial control of a business, or a trust that operates a business. The trustees of that trust become reporting people. They have to require reporting. The beneficiaries of a trust that operate a business that have more than 25% of the business are reportable people. There are certain exceptions. Q-tip trusts set up under wills, trusts that the grantor is the settlor of with a right to revoke and withdraw the assets are exempt. The companies have to report what's called a company applicant. That's the person who actually files the certificate of incorporation or certificate of formation. In our office, I have been a filer and one of my paralegals is a filer. We both have registered with FinCEN. So what that means is I have a dedicated FinCEN number, like my Social Security number, my PTIN number, and a bunch of other government numbers. So when I file, I put down my number, and if my assistant works with me, she puts down her number. And basically then what happens is we advise the client that your certificate of formation was filed on December 3rd, 2024. My FinCEN number as the filer is X. My paralegal's FinCEN number is Y. You now have an obligation to report within 90 days of today's date. And you have to report the name, date of birth, the address, and a Social Security number, foreign person identification number, and you have to back it up with a government document, a passport or a driver's license, and that is all going to be reported in this beneficial ownership information reporting. There's an obligation to report corrections within 30 days of any changes. So if you have a company that has a vice president of finance who leaves and you appoint a new vice president of finance, that information has to be reported within 30 days of that change. If there's a change in ownership, where someone new comes in and has more than a 25% ownership in the company, that has to be reported within 30 days of the change. If there's a change of address for any of the beneficial reported people, if you move from New York to New Jersey, that's a reportable event. If a person marries and changes a name, that's a reportable event. So there are a lot of obligations for reporting going forward that businesses and business owners are going to have to be aware of. And this is one of the reasons why a lot of the accounting firms and law firms, including our firm, will not take the responsibility of filing the beneficial ownership information forms with FinCEN. There are filing companies that can do it if you don't want to try it yourself. There are penalties for failure to report, failure to correct. There are civil penalties and criminal penalties. The non-compliant penalties can be up to $10,000, $500 per day, or up to 2 years imprisonment. So again, if the government wants to impose penalties, they have the obligation and the ability to do it. At this point, we've seen nothing to indicate that they're going to take any kind of enforcement action now, but again, these statutes are on the books. Again, you have to make sure that the ownership changes, anything like that is reported within 30 days. That becomes your reporting obligation. The FinCEN in the U.S. is modeled after what the European countries are using. We have one of the most lax reporting standards in the basic economic world. Most of the European countries have already adopted similar enforcement and regulation statutes to combat money laundering and terrorism. But we're a little late in the game, but again, it's obligation to get it done. If your clients haven't filed this year for any company that was set up prior to December 31 last year, you've got 28 days. You've got 90 days from the date a company was set up this year, and after January 1, you've got 30 days. Thank you.
The scary part of the CTA is that information, and you saw that's all very sensitive and personal, is available to every law enforcement agency in the United States, federal and state. So you're going to be out there with very sensitive information on a data bank, which could potentially be hacked, and the consequences are overwhelming. The firm, like most firms, would not be filing your CTA registrations, but we want to help. So if anybody has questions about it, we can send you a one-page how-to email, including the information for a filing service that will do it for you at a relatively modest fee. So we don't want to leave you hanging out there, so we do have resources for you. Thank you, Marty. Our next presentation is by Sean. He's going to talk about what happens if you screwed up the administration of your GRAT, your Grantor Retained Annuity Trust, which we're finding a lot of our clients do. Thanks again, Marty. Sean?
We chose that picture? Great. Good morning, everybody. First of all, I'd like to thank everybody for coming out today. Secondly, I'd like to thank Steve and Marty and Jason. I've been with the firm for about a year and a half now. I was here last year for those people who were here. If you don't remember me, I wasn't on the panel. I was eating breakfast in the kitchen. So that's how I got started. So I figured I'd get more of a laugh other than just Steve this morning for that. It's admittedly dry topics this morning, important topics, but dry topics. So speaking of dry topics and very specific topics, what I'm talking about today are GRATs, okay? And as Steve pointed out, grantor retained annuity trusts. What's that mean? It means the grantor, the person who sets up the trust, set up a trust, funded it, and retained a right to it in some fashion, usually an income payment based upon a percentage of interest, so that they can make a discounted gift or not a gift at all to beneficiaries based upon the amount that they take back. How does that work? All right. So the feds have a interest rate called the 75/20 rate, in which if you retain an interest, you must exceed that rate to get back. Okay, so when you fund a GRAT, the idea is it's a bet, right? You're betting that the assets you put in that GRAT are going to outpace growth-wise the 75/20 rate that's applicable at the time that you funded the GRAT, okay? Here's the question I'm going to ask you. Anybody have a GRAT out there? One? Okay. Does anybody know why there are not a lot of them out there right now? I'll tell you. The interest rates have been high, all right? So if the interest rates are high, GRATs, you have to take more back, all right? So why is this a possibility now? Well, the interest rates are starting to come down. They fluctuated between 4.5 and 5, a little more than 5 this past year. And the market's likely to go up. Okay, so if you're trying to move assets from people with very little exemption left, they've used it because they funded a SLAT, but they still have more assets to move. The use of a GRAT, okay, can make that happen without using a portion of your exemption. So how do they fail? Well, one is pretty obvious. The assets that you put in the trust don't outpace the 75/20 rate, okay? That's one. So you have insufficient assets to make the payments back to the grantor. Is this a terrible thing? No, because ideally, or what's supposed to happen, is if it fails, all you do is get back what you put in to begin with. Second way these things fail is they don't follow the terms or they don't make the payments, all right? Which is how I've seen them fail. And you generally don't know they failed until after somebody passed away, and now you have a GRAT that you're trying to explain to the IRS when payments were and were not made, because that's the time you don't want the assets back, all right? Because they generally, hopefully, appreciated during that period of time. Or the grantor dies before the end of the term. Now, these trusts are grantor trusts, so as both Jason and Stephen pointed out earlier, there are certain characteristics to these trusts that make them taxable to the grantor. One of those provisions is what I call the swap provision, which is the ability for you to put assets in and take assets out at an equivalent value. So how do you deal with failed GRATs? Well, as I said, the most notable reason they fail is because the assets that you put in don't appreciate fast enough. So to prevent a failure, right, you have to plan ahead, which is all we do. We plan for failures. If you have to pick assets which you believe are going to outpace that 75/20 rate, and if they don't, you got to put different assets in, which means you got to swap them for something else. Another asset that you have that you could have done this with, all right? Depending on the age of the person whom you've set these GRATs up for or with, you may just blow the thing up, take it back, and start over again. All right. The term of the GRAT becomes key. All right. We've heard in the past few administrations in regards to how GRATs work, the rolling GRAT or the 2-year GRAT, meaning you fund it with assets year 1, and in 2 years you take back roughly the equivalent value of what you put in, rely upon its appreciation, and after year 2, it's out, right? Which sounds like something that works pretty efficiently, but you have to put the right assets in. All right. It's a mechanism they've been trying to get away or take away because it's an efficient way to get assets out and retain some kind of income interest or interest in the assets themselves. Another way of doing that, and what I've done in the past, is if you don't use public securities, okay, stuff that, stocks, bonds, whatever it might be, and you've got a client with a privately held business, all right, with cash flows that you can discount, all right? We're all familiar with the ability for fair market value discounts when you make gifts. If you take a asset, get a favorable discount, transfer that interest in the privately held business to a GRAT, right, and can take back pieces of the business or use the cash flow from the business, you can move a substantial amount of value out of your estate. Now, we talked about earlier the use of the higher exemptions, all right, and if those exemptions stay in place. So next year, $13,990,000. For people who are high net worth and are way above that number, and you've used it already, right, you got to have another mechanism to get assets out of somebody's estate, and a GRAT is a good mechanism for that. You have to make sure that you're making your payments on time, okay? And the part of those payments, there are rules in regards to that. No prepayment, okay? But you can wait till 105 days after the payment was due to make it, because sometimes you got to figure out what you're paying back with, all right? You can have the grantor exchange the assets for a promissory note, and they can use their own cash flows to pay themselves back, right, rather than just the business itself. Now, the grantor trust rules allow that to take place because the taxpayer and the trust are one and the same, so you don't trigger any of the gain associated with the appreciation of the asset, either once already put in the GRAT or what the appreciation on the asset was prior to its contribution. Another thing to remember is you can't make any additional contributions. Once you set it up, you fund it, leave it there, all right? Unless you're going to blow it up, don't put anything else in. If you want to do it again, set up a whole separate GRAT. A lot of times people will take different pools of assets, okay, and say, take this pool, put in one GRAT, take this pool, put in another GRAT, take this pool, and put in a third GRAT, all right? And they hedge it. Now, you have to be well aware of the life expectancy of the grantor, right? People who come in who might be 95 years old, this is probably not the product you want to use for wealth transfer. But you cannot make additional contributions to an existing GRAT. The other thing you can't do is pay the GRAT with a debt instrument. What does that mean? It means that the GRAT itself cannot issue an IOU to the grantor for the payment that it owed. All right. You cannot do that. It doesn't work. It's in the regulations how those things work. So what I would also say in regards to this is, and there are some differing opinions, and Jason and I have differing opinions on how these are used as well. The type of GRATs that you can use, okay? The idea of the GRAT is to minimize the tax associated with the transfer. All right. So what people will do is they zero these GRATs out, meaning that through the calculation used in regards to the contribution, the 75/20 rate, the life expectancy or term of the trust, the GRAT itself, because of the retained interest, has zero gift tax implication to it. All right. You got to survive. Okay, and depending on what the final terms of your GRAT, which is more than what I want to get into in regards to when and how you file a gift tax return associated with a GRAT and or generation skipping transfer tax exemption allocated to them. All right. There's a lot of mechanisms that need to go along with those GRAT setups. So, in conclusion, because the lights are on, I believe that though GRATs, though we had one person here who has experienced one, though they're not being used frequently now, they will be when the rates drop and the market continues to go higher. Thank you.
Thanks, Sean. Shifting gears a little bit, I want to talk about the recent Supreme Court case of Conley versus the United States. A lot of us are advisors in the room. We advise clients, business owners, and many people here are in the insurance business. So this is going to be very important to those people in particular, and any business owner. Conley had to do with the impact of an insurance-funded buy-sell agreement structured as a redemption. The Conley case is a story of two brothers who owned a business. They operated as a corporation. They entered into a buy-sell agreement with the corporation, pursuant to which the corporation agreed to purchase the shares of a deceased shareholder in the event of his death. They agreed that they would set the price for the shares on a certificate of value basis, meaning every year they would agree upon a value. In fact, they never did that. They never signed a certificate of value, even an initial certificate. The company then purchased life insurance on the life of each of the brothers. The policies were owned by the company, and the death benefit was payable to the company, the idea being that in the event of the death of a brother, the company would use the proceeds to buy out his shares. So one of the brothers died. He was a 77% owner, and his estate and the surviving brother and the corporation all got together and agreed that they were not going to have an appraisal done. They had never signed a certificate of value, and they basically arbitrarily agreed on a $3 million purchase price for the shares. The price was paid using the proceeds of a $3.5 million life insurance policy on the life of the deceased shareholder. The estate reported the value of the shares on its estate tax return at $3 million. The estate was a taxable estate, so including that amount at that level was significant as to whether the estate would actually pay an estate tax. The IRS looked at the return, audited it, and it concluded that the methodology used to set the value, particularly since the parties to the transaction were related, was invalid for setting the value for estate tax purposes. In addition, and probably most importantly, and for the first time, the IRS asserted that the proceeds paid to the company should be included in the value of the company for purposes of determining the estate tax value of the shares held by the decedent. That was a unique approach, surprising to all of us in the tax world, and of course the estate paid the tax and sued for a refund. The case went to the district court and ultimately to the 8th Circuit Court of Appeals, both of whom determined that the IRS was correct, that the proceeds should be includable in the value of the company for purposes of setting the estate tax value. But more importantly, they overruled the 2005 case of Estate of Blount, B-L-O-U-N-T, if you want to look it up, versus Commissioner, which also agreed that the proceeds are includable in the value of the company, but also stood for the proposition that because of the contractual obligation of the company to buy the shares, that was a complete offset to the increase in value, and therefore there was no incremental increase in value by reason of having this be an insurance-funded buy-sell agreement. The court decided to overrule, the Supreme Court decided to overrule Blount, and agreed with the Circuit Court of Appeals. Its holding was to the effect that the corporation's contractual obligation to redeem the shares at fair market value does not reduce the value in and of itself, so they disagreed with Blount, primarily on the basis that no willing buyer purchasing the decedent's shares would have treated the corporation's obligation to redeem the shares as a factor that reduced the value of the shares. Valuation of any asset, which all of you know is what a willing buyer will pay a willing seller. So using the willing buyer analogy fit within that parameter. To show you the consequence of it, let's assume that A and B own a company worth $10 million, and that's a bona fide value, and they each own 50%. If they enter into a buy-sell agreement funded with insurance, under which the company would agree to purchase the shares of a deceased owner and fund that with $5 million of life insurance policy, a life insurance policy, that's very common, and that's exactly what was done under Conley. Under Conley, if one of the owners died and was bought out using the proceeds, for purposes of estate tax valuation, even though the $10 million was supportable, Conley would say that the company was worth $15 million, adding back the $5 million of life insurance proceeds, and the decedent's estate would be responsible to include $7.5 million on the estate tax return, not the $5 million that it actually received. What are the implications of this? For taxpayers who are concerned about their estate tax liability, they're not going to use insurance-funded redemption agreements any longer. This will basically put the end to that. Now, there are going to be clients who don't have the worry about an estate tax liability, which may use this approach. It's an easy approach because the company owns the policies and pays for the policy, so it's very convenient. That will obviously not be the preferred choice in many instances. The alternate to that is a cross purchase where each shareholder agrees to buy a proportionate share of the shares of the deceased shareholder in the event of death. It really doesn't work well where there are a number of shareholders, more than two, because you would theoretically have to have an insurance policy owned by each shareholder on the life of each other shareholder. You know, think about that. Do the math. If there's 10 shareholders, that's, you know, dozens and dozens of policies that would have to be purchased, managed, administered. What other strategy can you use? We use what's called a partnership insurance structure. How this would work is that the owners of the corporation would agree to form a partnership or an LLC. I'm going to refer to it as a partnership. They would each own an interest in the partnership. Their interest would be exactly the same as their interest in the corporation. The partnership would then purchase a policy on each shareholder's life, so there's one policy per life, and would be the owner and beneficiary of those policies. The partners would have to come up with a funding mechanism. Who's going to pay for the insurance? How much must each of them contribute to the partnership to cover the premium costs? And normally that would be done on the basis of their relative share interest in the corporation. Although oftentimes the partnership will actually enter into a premium funding arrangement where a third-party lender will lend the premiums to the partnership secured by the cash value of the policies. At the time of the death of a partner, or a shareholder rather, the partnership will collect the proceeds and distribute the proceeds among the surviving partners, who then use the money pursuant to a contract to buy out the interest in the corporation from the deceased owner. This allows for the purchase of one policy per owner. It allows for administrative ease of managing the policies through a premium funding arrangement that the partnership agreement would provide for. It allows for equalizing the costs of the premiums as among the members. And it gives you flexibility if in fact owners of the corporation change. Either you bring in new owners, somebody retires during lifetime, has their shares bought out. In that instance, the new partners would come into the partnership as partners. The old partners, the old shareholders would exit the partnership and maybe get their money back. It's very effective for tax purposes. As long as you purchase the policies initially when you set up the partnership, there's no transfer for value rule implicated. And even if you're going to transfer over existing policies to the partnership, normally a transfer by a person to a partnership of which he is a partner is not a transfer for value trigger. The life insurance proceeds received by the partnership are tax-free, as is the case with most life insurance receipts. That's income tax-free. The death benefit received by the partnership is referred to as tax-exempt income, so it's not subject to income tax, but it does increase the tax basis of the partners in their partnership interests so that when the money is distributed out to them, there's no income recognized because they receive an equivalent amount of the proceeds equal to the value or the basis accretion resulting from the receipt of the proceeds. And finally, and most importantly, it gets around Conley because the proceeds are not received by the company, they don't increase the value of the corporation, and therefore we don't have the Conley problem. We use this strategy extensively because it's convenient and easy to manage. More importantly, though, it's going to be imperative now that Conley is out there. Conley is not going away. I think all of us were scratching our heads for months as to how this possibly happened, given that, it really made no sense and materially adversely affected a planning strategy that's been in place for, scores of years. So that's Conley. I think that's going to be important to a lot of the planners in the room.
Before we move on to our next topics, we thought this would be the perfect time to kind of pause for a moment of levity. As professionals, I know you guys spend your time talking to clients, guiding them through their finances, and you've probably encountered a situation or two where a well-meaning family member or even a client is absolutely certain about their financial choices. Does that sound familiar to anyone? So this next clip is from Schitt's Creek, and it humorously captures one such moment. In it, David Rose receives a memorable lesson from his dad. I think many of us will relate to his dad's reaction, so let's take a look.
What's this? Looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the store, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchased skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the bedding's non-refundable, so...
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
So while David's approach may be amusing, it does underscore an important point that the right guidance is critical, especially when it comes to navigating the evolving laws and financial strategies. So speaking of which, our next session provides an update on the Secure Act 2 and its impact on retirement planning and estate strategies. So to walk us through these important changes, please join me in welcoming back Martin D. Hauptman.
Thank you. Nice to be back again. I'm going to be talking about the Secure Act, but I just want to go off script for 1 minute because I had a conversation with a client last week doing planning, and he said, well, we're structuring his will, and he said, well, I want to leave my IRA too, and I said, stop right there. apparently there's a lot of people who are under the misconception that you can leave an IRA or a qualified plan under a will. Those documents require a separate beneficiary designation form. You have to have a beneficiary designation form with your IRA or a 401k or pension plan. So again, those things don't pass under the terms of a will. All right? So basically, what have we got now? We've got Secure 2.0. ERISA came out in 1974, and they constantly update it. And they've made a number of major changes in Secure 2.0. I'm going to touch lightly on some of the topics that I think will be of interest. One of the new things is mandatory automatic enrollment. And this basically requires new plans to require eligible employees to be automatically enrolled with a 3% salary contribution. And this increases 1% a year up to a maximum of 10%. The rationale is that most people, when they sign up at a new job, are just going to be automatically put into it. They do have the election to waive out of it. To further encourage that, they are giving tax credits. Oh, tax credits, huh? Is that different than a deduction? For businesses that set up plans for employees that have the automatic enrollment. The credits are up for between $500 and $5,000 for the first 3 years that the plans are in existence. And there is an additional $1,000 a year credit for plans that have an automatic enrollment feature. Another big change that's coming out with Secure 2.0 effective for 2025 is eligibility for part-time employees in 401k plans. So any company that has employees who work 500 hours a year on a regular basis are now eligible to participate in 401k plans. Okay, they can be subject to the automatic enrollment provisions, withholding 3% up to 10% over a number of years. Another significant change is the student loan repayment benefit. And this provides that employers are allowed to make a matching contribution for employee student loan repayments. This means that the employee who makes a student loan payment of X dollars, the employer can contribute a matching amount into the 401k for the employee. And the purpose of this provision was to address the student loan crisis, to allow people suffering or encumbered by student loan debts to continue to save for retirement. There are certain requirements that the employer has to include in their plan documents to allow for this. Another major change is the linked emergency savings account. And this allows an employee to deduct on a pre-tax basis up to $2,500 per year, segregated into an emergency reserve account. This is different than the 401k account, so that the employee has access to funds in the event of a financial emergency. Could be health, could be a credit card debt, other medical or financial emergencies. And then there can be automatic enrollment in this provision. The amounts that are there can continue to stay there if they're not used. So in theory, the $2,500 could be added to each year. And the benefits to the employees are the contributions to the emergency savings accounts are made on a pre-tax basis, similar to a traditional 401k contribution, and they come out penalty-free. There's still a tax, but they come out penalty-free. The benefits to the employers, it may help employers attract and retain employees by offering this additional benefit. It can create a positive work environment by the employee not being subject to financial stress. Another very significant change in Secure 2.0 is the expanded use of 529 plans. 529 plans were set up as educational savings accounts. They can be used for designated children, grandchildren, but Secure 2.0 allows you to take unused 529 funds and contribute them to a Roth, so you can roll over excess funds for the benefit of the named beneficiaries of the 529 plan. There are several criteria. The money has to have been in the 529 plan for at least 15 years. There's a maximum of $35,000 that can be rolled over effectively from the 529 plan to the Roth account. So that's a very significant feature in the Secure Act 2.0. Secure 2.0 has changed some of the penalty provisions and allowed for greater flexibility in correcting plans. They've expanded the self-correction procedures for plans that have what they deem minor violations. They can be done without formal submission to the IRS in the voluntary correction program. The operational errors that can be addressed with the self-correction program are related to employee eligibility contribution calculations or failure to follow plan provisions, provided that these were done inadvertently and not with an intent to slight or disadvantage certain classes of employees. And the other option is to correct document compliance issues. These have to be corrected within a 2-year period from the date of discovery, and the documents have to be revised to reflect the changes. We've assisted clients with some of these self-correction provisions, and basically how it operates is it's almost like a plan audit. We go through, we say, okay, we've inadvertently excluded 3 employees, and what happens is we go back, we say that had they been included as of the date they were entitled to be included, their allocation would have been X dollars. We then go to the Department of Labor website, which gives you the amount of theoretical lost income that the participant would be entitled to. We then calculate what has to be contributed for that employee, and then the company makes the correcting contributions, and then basically we notify the participant that due to an inadvertent error, you were deprived of a contribution of X dollars. Your account has now been credited with X dollars to make up for the error that was made. And as long as these are not deemed to be what they call egregious, no definition of egregious, you can use self-correction. If the discovery is more than 2 years, you have to go into voluntary correction program at the IRS. They've reduced the required minimum distribution penalties for failure to make the required minimum distributions. Prior to the law, the penalty was 50% of the required distribution not made. This has been cut to 25%, and in certain cases, it can be reduced to 10% if the corrective distribution is made and the tax is paid at that point. They've also changed the distribution ages. Right now, the age is 73, and in 2033, the age is going to be 75 for required minimum distributions. And then they've also changed the life expectancy tables to give us a longer life expectancy payout based on the longer life expectancy of today's adults. And I thank you.
Hello again. No jokes this time because they failed last time, so we're not going to do it again. So basically, when I do planning for somebody, okay, the last question they always ask before how much was it is, that was a joke, when will I have to redo this again? Okay, so I always tell them there are 4 core principles. There are more now. Those principles are: did somebody get married? Okay, whether or not it's the client or one of the client's kids. Okay, did somebody have children? Okay, whether that's the client or then again the client's children have kids themselves, grandkids. Has there been a divorce? Okay, that causes you to want to change how the plan works? Or has somebody died? When I say somebody, I mean a spouse, a potential beneficiary, or whom I like to refer to as the go-to people, the people you have in your documents that you're relying upon either as an agent under a power of attorney, a trustee of a trust, an executor of your estate. All right. Now, with the way the markets have gone and the exemptions have changed, okay, that's my 5th thing. All right. So now instead of 4, it's 5. Okay. As the exemptions have gone up, have the documents that these clients had in place since 2015, which doesn't really sound that long ago, but is okay. Do they still work, or will they have unintended consequences? All right. I'm going to focus really on 3 factual backgrounds in the sense that affect this. Okay, the feds we all know about. All right. As of January 1st, 2018, the exemption doubled. Okay, it was approximately 11 million at that point in time. As we already mentioned, next year it's 13,990,000. Will it go back in half or not? Who knows? What's that half number going to look like? Is it going to be 7? Is it going to be 7.5? Probably 7.5. If it gets there or not, we have no idea. Okay, we have to remember that the federal exemption has portability that is not part of that sunset, so the portability is locked in. So they're always going to have that. Okay. And the annual exclusion amount is going up next year as well. That's the amount that you can give away per person per year that doesn't affect your unified credit or the exemption amount. That's going to 19,000. Okay. New Jersey, as we all know, got rid of its estate tax. Okay. Not its inheritance tax, totally different tax, but got rid of its estate tax. Okay. And New York, I'm going to throw in here for fun, still has an estate tax. Its exemption, as of this year, we don't know next year yet, 6,940,000. By the way, if you pay attention to what it is next year, that would be your half number, because both New York and the Feds started at the same spot, but New York didn't double like the Feds doubled. All right, and a key part of New York is that there is no portability. Okay, so the deceased spouse, it's a use it or lose it proposition. You got to use your exemption. You don't use your exemption. Okay. So what that has meant historically for a lot of people who did their planning pre-2018, okay, whether or not New Jersey or New York, New Jersey specifically is, most of those documents have some type of bypass trust, okay, meaning a trust that's established by the deceased spouse for the benefit of the surviving spouse, all right, and it's funded usually using some type of formula or by disclaimer meaning that the surviving spouse has said, hey, I don't want the assets, and the will says, okay, if my spouse disclaims these assets, put whatever that disclaimed amount is into a trust for their spouse's benefit. There are a bunch of different nuances to that. I'm not a big disclaimer person when it comes to structures. You're either funding a trust or you're not funding the trust. But what those trusts do, if you use the formula approach, and it says pass the largest amount tax-free that I can pass tax-free and stick it in a bypass trust, that might be everything, okay? Which is generally not what you would want or the surviving spouse may want. For several reasons. The unintended consequence of putting all the deceased spouse assets into a non-desirable trust. Well, first of all, spouses generally don't want them anyway. They like them just a little bit more than a kid, as far as the kid getting the trust. But what that does is those trusts, those bypass trusts, are designed to not be includable in the estate of the surviving spouse when they pass away. So what does that mean? Whatever went in there and whatever it grew to during the lifetime of that surviving spouse is not going to be subject to basis adjustment upon the death of the surviving spouse. So we've lost out on a non-taxable event, which would have been non-taxable anyway, and get to pay the capital gains tax at the end if we don't otherwise manage that aspect of it. All right. There are ways to manage it, and you can manage it all post-funding so long as the document itself was written with some type of authority to get the assets back out. Whether or not it is the independent trustee, I call him the independent trustee, Steve called him something different in the SLAT, that has the ability to appoint the assets out to or for the benefit of the surviving spouse. Now, the surviving spouse can't do that because otherwise it wouldn't have worked. If they can give themselves the assets, the bypass trust would not have worked. But you can have somebody else give it to them. That person can't be interested. As long as those terms are in there, most of the time it's that power of appointment, you can get the assets back out. But remember, those trusts in 2012, 13, 14, were designed in New Jersey with an exemption that was $675,000, right? A ridiculously low amount now that we think about it. Well, we thought about it then too, and it was still a ridiculously low amount, but yet it existed. So those documents may have a problem, because they may have that unintended result that goes along with that. Now, that's not to say that the bypass trusts themselves are a terrible idea. They may serve other purposes. One of those is generally creditor protection purposes, or what I like to say, you want to protect the assets that your surviving spouse gets from you from the pool boy or the pickleball coach or somebody in that regard who has an idea for a bar, a good idea for a bar. There's no such thing as a good idea for a bar. So there are reasons for those trusts, and sometimes they're set up, and they do this when one of the spouses is in a profession with a high liability, like a doctor, okay? Heart surgeon, brain surgeons, those people who could be subject to creditors later. If you have them inherit everything, you usually don't want to do that. You may still want that bypass trust with the mechanism in it that prior to somebody passing away, we may need to get some assets out of there to adjust for basis issues. The other reason you may want that, depending on what their net value is you may want to allocate GST using the deceased spouse generation skipping transfer tax exemption at that point. It all has to do with the facts and circumstances at the time. A means of, so then the client will say, well, I paid X numbers of thousands of dollars for my 50-page will, okay? I have not written a 50-page will in a long time, because generally it's all a bunch of stuff that's not necessary or can be condensed in some fashion. You can bypass the bypass trust, pun intended, simply by changing your asset titling, okay? So if, when you did that original planning, you would have established assets owned by both individuals, not jointly, right? Joint owned assets automatically will pass to the surviving owner, okay? Which means the will doesn't count. Very much like what Marty started his presentation with, non-probate assets like your retirement accounts don't go through the will unless you direct them there. Because they're gone by designation, beneficiary designation. Same thing with the joint account, meaning if it's a investment account, checking account, or if it's a jointly owned home, you can bypass the bypass trust simply by changing the titling of the assets, and maybe the rest of the will, as far as trust for the benefit of kids or grandchildren works, you don't have to replace the whole thing, and you don't have to spend thousands of more dollars to replace the documents that look so pretty in your 3-ring binder. Now, that's New Jersey and the feds. New York, as I pointed out, still has no portability. So the use of the bypass trust is still necessary in New York, depending on the value of clients' estates. The other thing about New York is over time, it has become more difficult to administer estates in New York. So if you have clients in New York just using the will concept, even if it's got all the bells and whistles inside the will, been encouraging clients to replace those wills with revocable trusts. All right. The reason for that is, I had a client who passed away in Queens County. It took over a year to get the spouse appointed the executor of the estate, just because there was nobody working in the surrogate's office. Shauna, who does New York stuff, is nodding her head as well, is that, yeah, it takes a while. You can avoid that, or a lot of it, by using a revocable trust and properly funding it. You can't forget to properly fund the revocable trust. It is becoming actually more popular in New Jersey as well, because people are looking to avoid probate no matter how easy it may be, because they want more ready access to the assets, notably non-spouse beneficiaries. The other thing I tell clients is, about every 10 years, you want to take a look at this stuff, all right? Are the people that you have in there the people you want in there? Are they still your go-to people? Have they changed over time? You know, you might not need guardians anymore. Maybe the kids are now the go-to people. So it makes sense when you see somebody's documents, take a look. Generally speaking, if they're 50 pages long, you may want to have them looked at. Thank you.
Thanks, Sean. Finally, Jason is going to talk about some legislative predictions, legislative updates. A lot has changed since the results of the election, and it's really going to impact what everybody does in the planning for the next couple of years.
Okay. I guess I'm last?
We have a couple of wrap-ups, but yes.
Well,
Stay on time.
I guess he knows me. By a show of hands, who knows that there was an election last month?
Yeah.
And unless you've been afflicted with Sleeping Beauty syndrome and you're back to the real world, welcome back. We all know that the Republicans have taken over the administration and both houses of Congress. And so it's very likely that we're going to see some legislation in the tax area in the coming year. So, you know, while Congress may try to take a bipartisan approach, there is the possibility that the congressional Republicans, along with the administration, will have the ability to use the filibuster-proof budget reconciliation rules, which allow for less than 60 votes in the Senate, to pass or at least extend the legislation that exists now. And what do we have now? Right now we have what exists as the 2017 Tax Cuts and Jobs Act. It's TCJA. TCJA is the acronym. This was a significant piece of legislation that was enacted in December 2017 that was passed during Trump's first term, which had significant changes to individual, corporate, estate, and international tax areas. It's scheduled to expire in 2025, or at least many of the provisions are scheduled to expire or sunset. But those of you who have paid attention to the campaign that occurred this past fall know that the administration is looking to make many of the provisions in TCJA permanent. So let's talk about what are the provisions that are scheduled to sunset. First of all, the lower individual income tax brackets. Currently, tax brackets are 10, 12, 22, 24, 32, 35, and the top bracket of 37%. If TCJA does sunset, the 10% lowest tax bracket will remain the same, 12% will jump to 15%, 22% will jump to 25%, 24% will jump to 28%, 32% will jump to 33%, 35% will remain the same, and the top tax bracket will become 39.6%. Standard deduction for individuals. Under TCJA, initially, for married filing jointly, taxpayers, the standard deduction was $24,000, $18,000 for head of household, and $12,000 for single filers. Adjustments for 2024, those numbers are $14,600 for single filers, $21,900 for head of household, $29,200 for married joint filers. Those will revert if TCJA does sunset back to $13,000 for joint filers, $99.50 for head of household, and $6,500 for single filers. So big, pretty significant reductions in the standard deductions. Increase in child tax credits. Under TICSA, the child tax credit was increased from $1,000 to $2,000 per child. Trump's campaign has suggested that they would be interested in trying to increase the child tax credit to $5,000. If TICSA does sunset, we would be seeing a child tax credit for individuals back to $1,000. We've talked a lot about the estate and gift tax exemption amount under TICSA. Currently, it's $10 million adjusted for inflation, which means for 2024, it's $13.61 million. It's scheduled to increase to $13.9 million in 25. But if TICSA is allowed to sunset, we're going to see a reversion back to the $5 million exemption adjusted for inflation, so we'll be up to about a $7 million exemption per person, or about $14 million for a married couple. While those numbers do seem large, based on the number of taxpayers affected by the estate tax, it's really not so. In 2022, which is the year of the most recent statistics, about 3,170 estates were subject to federal estate tax, compared with 5,185 that were subject to estate tax prior to the enactment of the Tax Cuts and Jobs Act. Given the relatively small number of estates that are affected by the increase in the exemption amount, it's probably a good idea that we can expect to see that the exemption will remain where it is. The 40% tax rate has been remain permanent. It will remain permanent unless that's changed by legislation. For those of us who are the CPAs in the room who love tax codes, Section 168K, the bonus depreciation section. Under the Tax Cuts and Jobs Act, corporations could depreciate certain assets substantially in the first year. This is the so-called bonus depreciation, and that increased the deductions in the first year relative to those certain assets from 50% to 100%. But those amounts have begun to decline beginning in 2023 and are phasing out in 2027. So a sunset would probably not have much of an effect on the bonus depreciation, but we could probably expect to see somewhere in the middle of between 50 and 100% for those companies that are phasing out at this point. Also, for our CPAs in the room, Section 199 Cap A, the qualified business income deduction. TICSA included measures that were meant to reduce taxes for certain pass-through entities. Section 199 Cap A provided a deduction equal to 20% of qualified business income for most, although not all, pass-through entities. If TICSA does sunset, this provision will be eliminated in 2026. Section 199A does have a lot of political support, so it's likely that that will remain unchanged. Again, some the international tax issues that have been affected by TICSA. Section 951A of the Code, which introduced a new tax on global intangible low tax income, or GILTI, was intended to prevent U.S. multinationals from shifting profits to low-tax foreign jurisdictions. It imposes a minimum tax of 10.5% on certain foreign earnings. That's scheduled to increase, or slated to increase, to 13.125 or 13.125 after 2025. Section 250 allows U.S. corporations to deduct their foreign-derived intangible income, or FDII income, which is defined as income from exporting products, services, or intangibles from the U.S. The deduction reduces the tax rate on FDII to as low as 13.125 of eligible income, but is increasing to 16.4 after 2025. And Section 59A is based on the Base Erosion and Anti-Abuse Tax, or BEAT, was intended to prevent large multinational corporations from eroding U.S. tax base through deductible payments, mostly interest and royalties, to related foreign affiliates. BEAT operates essentially as an alternative minimum tax of 10%, rising to 12.5% in 2025. There are some changes that were affected by TICSA to renewable energy tax provisions. The Inflation Reduction Act of 2022 introduced a series of tax incentives and credits that have spurred a wave of investment in clean energy manufacturing. These include clean vehicle credits under Section 30D, the clean electricity production credit under Section 45Y, the production tax credit under Section 45X, clean fuel production credit under 45Z, and energy investment credit under 48. Trump has indicated interest in rolling back some of these credits. However, there is some popular support for keeping them and not rolling them back as a result of his administration. Further changes that we can expect to see with respect to TICSA. The corporate tax rate. Before the Tax Cuts and Jobs Acts, the corporate tax rates were 15, 25, 34, and 35%. TICSA replaced the tax brackets with a fixed corporate tax rate of 21%. We can possibly expect under the new administration that the corporate tax rates will be reduced further to 20% or possibly even down to 15%. One of the other items that was discussed during the administration's campaign was the removal of the SALT deductions, the state and local tax deductions. There currently is a cap as a result of the Tax Cuts and Jobs Act of $10,000 per household, essentially. There's been discussion about either eliminating that or possibly increasing the cap to $20,000. Other proposals that are on the horizon: no tax on tips or Social Security benefits or overtime benefits or income for police officers, firefighters, and members of the military. Tax for caregivers taking care of family members may be eliminated. Deductions for interest paid on car loans for American-made cars is another issue that's been addressed. The question, of course, is how are these going to be paid for? And I think the result in everybody's mind, let's all say it together, tariffs. With that, I think I'm done. Thank you all very much for listening.
To wrap up, Marty and I are going to share some numbers with you. His are in the materials. Be sure to scan the QR code to get the materials. Mine are not, so write these down. These are for 25. They are short-lived, potentially, because of what might happen in connection with tax legislation next year. The standard deduction is going to go up to $30,000 for a married couple, $15,000 for a single. The highest rate bracket will apply, that's the 37% rate, to an individual at a taxable income level of $626,000, and for a married couple about $751,000. The gift tax annual exclusion is going up to $19,000, and as a number of the panelists have indicated, the estate tax exclusion amount is going to be increased to $13,999,000 per spouse. That's a $380,000 per spouse increase. Marty's going to talk a little bit about the numbers that affect qualified plans and IRAs.
Well, in 2025, we have a new catch-up provision for 401k plans. Under the current law, if you're over 50, you can make an additional $7,500 contribution to a 401k plan. That number hasn't changed from 24 to 25, but for calendar year 25, we have a new category of people, those aged 60 to 63 at the end of the calendar year. So if you're 60 at the end of calendar 25, or 60 up to 63 by the end of calendar 25, you get an $11,250 catch-up contribution. That's not in addition to the $7,500, that's in lieu of the $7,500. So you're picking up an extra almost $4,000 for contributions to a 401k for catch-up. The 401k contribution for 25 is increased by $500 from $23,000 to $23,500. And the 401k 415 limitations have increased from $275,000 to $280,000. And the compensation for top-heavy purposes has increased from $220,000 to $230,000. And the premiums for a longevity annuity, which kicks in at age 85, has increased from $200,000 to $210,000. And the annual compensation limit for 401 plans, A7 plans, 17 plans, has gone from $345,000 to $350,000. So there have been some inflation adjustments. The real big change is the category 60 to 63.
Thank you, Marty. That concludes our presentation. We're going to take questions. We'll stay as long as you need, but first listen to some very important announcements from Lauren, please.
So as Steve mentioned, we're just about to jump into our Q&A, but I did want to say thank you to all of our speakers today. We've covered so much ground, and I really hope that you guys are walking away with some really valuable information. There is a QR code on everyone's table. It's also on your notepad there. We would love it if you could give us some feedback, help us to keep these events fresh and relevant every year. And as a bonus and as a thank you to you, we will enter you into a raffle for a really great prize. Not only is it a To-Me backpack, it's also full of some really great things in there. There's a mug, there might even be an iPad in there, just saying. So thank you very much for helping us to keep these events relevant every year. So let's get into some Q&A, and then I'll pop back up and we'll get a winner.
My question's for Donnie. On average, if a couple wants to combine their assets in order to engage in annuity planning, how much of those assets would be able to be preserved?
For a married couple?
Yes.
For a married couple, you can preserve almost 100% of the combined marital assets. It's really good compared to single person with a single person Medicaid combined annuity. Then on average, they anywhere between 40 to 50% of the assets. A married couple can shift all of the assets to the benefit of community spouse through the Medicaid combined annuity. There is a small cost to purchasing this annuity, but it generally does not exceed $3,000.
I actually have a follow-up question for Donnie. Sometimes we see people who unfortunately are looking for what we call Medicaid divorce. People who feel like they have no option because the spouse is in bad shape and they need to qualify. Are the annuities you're talking about the type of vehicle that they could potentially use to avoid having to go through that process?
Essentially. And it really depends on how those assets are held. Typically, Medicaid divorces are good in situations where we have a majority of the assets belonging to one spouse held up in retirement accounts. Those retirement accounts then would be met with sizable tax consequence by the creator. In that case, sometimes Medicaid divorce is useful because by going through the divorce process, you can acquire from the Superior Court and essentially allocate those retirement assets among the spouses, reducing the tax consequence and spending down the applicant's spouse much quicker.
Thanks.
My question is for Steve in regards to Conte. I know that you said that the partners were supposed to set value for their business, and they obviously didn't do that, and that's why they were in that pickle. If they had done that in the first place, would that have bypassed Conte, and would that have helped them? So here's my question in the sense is, can you also draft within the partnership agreement a value, and then also have the insurance pay that company?
Good question. Under Section 2702 of the Code, the setting of a value in a related party transaction is not respected for tax purposes. You need to have an independent valuation either at the time of death or at the time of setting the certificate of value. So no, it would not have worked. they were exposed regardless of having done that.
Morning. You talked about the CTA and the BOI reporting. What do you do about trust, especially with USST?
Well, if the trust has an active business, it becomes a reporting entity. If it does not have an active business, it's not a reporting entity.
Although the trustee is a reporting person, the trust owns a business interest in a reporting entity. So the trustee is it stands in the same place as an officer of the corporation, for example, or a beneficial.
What about the beneficiaries?
Certain beneficiaries, I believe, Marty.
Beneficiaries of the trust that engage in an active business become reporting people.
So if a beneficiary has a power of appointment, for example, which gives him the ability to affect beneficial enjoyment of the assets of the trust, he becomes a reporting person. A passive beneficiary does not. In other words, a discretionary beneficiary.
Any other questions? All right, so we're going to pick a number. If someone can just give me a number from 1 to 50. Anybody have a favorite number out there? 12, okay. 12 it is.
Vivian Fisher.
Vivian Fisher? There we go. Congratulations. So thank you all again for joining us today and for all of your feedback. We are so excited to see you again next year, and we hope you guys have a wonderful day and safe travels back.